You have to forgive me a little bit today. Day three of COVID, so far so good, but yeah, my voice might sound a little bit deeper there. Yeah, so right now, looking at a deal, we're putting an offer together on a business in the logistics space. Business is overpriced, so typically businesses within this sector go for a maximum of 3.2 times the SDE times the EBITDA. In this case, the business owner is dreaming. He wants I think it's 4.2 times the net income of the business. So that's one of the issues. The other issue is um, it's doing great this year, but the past 3 years have it started low. It's growing massively over those 3 years. So it went from something like $50,000 to 150, and now it's like five, mid 500 in terms of net income. So the challenge with this is, how do we value a business like that when typically valuations are done on a 3-year average? How do we value that? So what we've essentially come up with, if we've come up with a deal where we're structuring it. So we've valued at a true market valuation. So we just average that over 3 years. And, we find the true net income of the business. We average it over 3 years. And we're going by the market multiple there. So that is the true valuation. We're going to put an offer based on 80% of that. And then the remainder is going to bridge the gap from the asking price to what we're asking. So what we're willing to pay. So the asking price is obviously much higher than what is reasonable, which is fine. But what they've done is they've just looked at the last 6 months. Oh, the last 6 months have been going well. And they're assuming that life will continue as it is. Now, obviously, from our side, we know that that may or may not be the case, but we cannot pay you for that. Yeah. The other challenge with the business is that it doesn't have long-term contracts. With the earnout, that's fine. We'll just structure it as an earnout there. So again, we're going to pay 80% of the market valuation, and then we're going to bridge that gap with an earnout that's based on the revenues of the business. So we'll see how that goes, see the owner's feedback. Honestly, from their side, it's a win-win because we are very reasonable with our offer. It's market valuation, but they get they get potential upside from that. Really, it just matters where, kind of what they're doing with what are they going to do with the business. Other metrics that we're going to tie to this. Ideally, we'll tie it to the net income, so we'll attempt that. Realistically, they're probably going to want to tie it to revenue because they cannot guarantee, that we're not going to do some financial shenanigans. So we're essentially, reinvest some of the money inside the business for long-term growth that will lower the net income of the business over the short term. So that's our goal. Hopefully, we'll have a conversation with a little bit later, and hopefully that goes well. We'll see from the owner's side. This deal, because of its lack of stability, someone's got to take up. We've got to mitigate some of that risk, and so this is a structure that we thought of that might help, both of us get what we want. And really for the owner, get them to put their money where their mouth is. But yeah, I'll keep you updated on how that offer goes. And if it goes through, we'll keep you updated.